Hello, everyone, and welcome to Seven Investing, where it is our mission to empower you to invest in your future. I'm Seven Investing founder and CEO Simon Erickson, and I'm extremely excited to introduce my guest today, who I truly believe is one of the smartest minds in the financial world. Morgan Housel is one of the partners at the Collaborative Fund. He has been a presenter at conferences all across the world, and he's also an author of his new book, The Psychology of Money. Hey, Morgan, nice to chat with you, and thanks for joining us at Seven Investing.
Happy to be here, Simon. You and I worked together for several years. It's good to be back here chatting with you.
It sure is. Nice to talk with you again, Morgan. Now, your book is a gold mine of information. It's very, very good. I just read through it. And to kind of make this fun and interactive, I've gone through and I pulled out 7 themes that I think kind of represent what you're trying to get across in the book. It had to be 7 because we're Seven Investing, of course. But I wanted to pitch each of those to you and see if you could talk about each one of those. And then I've also got some examples from the book and an investing related question for each one of those. Does that sound okay? And are you ready to get started, Morgan?
Let's do it. I'm ready.
Okay, the first theme is what I'm calling the psychology of money, which is actually the name of your book itself. This is the idea that investing is really a personal thing. And there's so much number crunching and data that goes on out there. But at the end of the day, you want to be able to sleep at night. And it's really meant to fit your own lifestyle. Can you tell us a little bit about kind of what the psychology of money was written for?
I think a broad point that I make in the book, as you mentioned, is that everyone is different. And we try to think of investing, we tend to be taught investing like it is something like physics or something like math, where 2 + 2 = 4 for me and for you and for our ancestors and for our children. It's always going to be the same for everyone, everywhere. And I actually think investing is not like physics at all. It's a much more personal endeavor where I think maybe the closest analogy is something like relationships. Whereas, look, are there common denominators? Are there universal truth of what makes a good relationship? Sure, people want nice people, empathetic people who are going to listen to them, help them out, etc. But everyone's different. What people are looking for is different. Their goals are different. Their incentives are different. What they find appealing or unappealing is very different. And that's true for investing as well. Like I love the quote from a financial advisor named Tim Maurer who says, "Personal finance is more personal than it is finance." I think that sums up so much what we do in investing. And actually a lot of the debates that we have in investing about when we are debating, is this a good stock to buy? Yes or no? Is this a good asset allocation to have? Yes or no? And when two people disagree on that topic, a lot of the times, I think even most of the time, it's not that they disagree. It's that they are viewing the world through a slightly different lens because they have different goals, different incentives. They want different things out of their money, which leads them to different outcomes, different strategies. And so I think the idea that people who are equally smart, equally informed, can come to very different conclusions is something that's really important in investing, because it's really important for individuals to realize that just because someone else disagrees with you, or because what you're doing with your money maybe doesn't make sense from what you read in the finance textbook, if it works for you, if it works for your own goals, I think that's great. I think that's perfect. That's the best you can hope for. One of the points I make in the book is that we actually should not aim to make purely rational financial decisions. There's this idea, I think, that people should make, like, we want to be rational. Is this financial decision rational? That's when you should do it. And I don't think that's right, because people are not machines. They're not spreadsheets. And rather than trying to be rational, I think people should just aim to be reasonable. And even if the decisions that you make with your money cannot be explained perfectly in an Excel spreadsheet down to the fifth decimal point, if they work for you, if they work for what you want out of your money, then that's great. That's the best we can hope for. So the psychology of money is just moving away from the idea that investing is not physics. It's actually something closer to psychology, sociology, a softer science where there are not a lot of hard, firm analytical truths.
Yeah, and one of the things I like that you really brought up, Morgan, within your book was that, and you just mentioned again, is that we have different goals and we're playing different games. And that will actually influence the price that we will pay in this giant online auction that is the stock market these days, right? It depends if you're a stock trader that's trying to get in and out in a day, like a day trader would be, versus someone who's saving for retirement. That might mean different things. It kind of influences the prices of assets out there, right?
Yeah, I mean, if you are a day trader, then, if you were to ask, is Netflix a good stock? All you care about is whether its stock price is going to go up between now and lunchtime. It's just based off of momentum or technical analysis. So the answer for you might be yes, it's a great stock. But if you are a long-term shareholder, and look, this is nothing against, I'm just using Netflix as a bland example. This is not my opinion of the company. But if you are a long-term shareholder, the answer might be no. So people are playing different games, and it's intuitive to think that there should be one correct price for a stock. Like, is this stock a good buy, yes or no? It depends on who you are. So think about, if you go back to 1999, and Cisco and Yahoo and Dell were trading at ridiculous multiples, ridiculous valuations. But the value, so if you're trying to answer the question, how did that happen? Why did that happen? Why did investors bid the prices up that much? I think at least part of the explanation is that prices were being bid up by short-term traders who were chasing momentum in a reasonable way that you can't fault them for. They were playing that game. They were playing the momentum game, and it worked for them. So they didn't care that Yahoo was trading for 7 billion times earnings or whatever it was. That was not the game that they were playing. They were chasing daily momentum. The problem, the issue, is when long-term investors looked at that and said, oh, maybe these people know something I don't. They're bidding the price up. Maybe that's the right price. That's the price I should buy it at. And then long-term investors started taking their cues from the short-term traders that bid the price up. And the real problem with bubbles happens when you have long-term investors who take their cues from short-term investors, and they're the ones who get left holding the bag. Because when the bubble went out, the day traders were gone. They cashed everything out, they were gone. The bag holders, the people who were left cleaning up the damage and who suffered the most damage, were the long-term investors who took their cues from those people. So I think just the realization that it might be intuitive to think that we're playing the same game in investing, and many of us are not. We're all playing on the same field. There's only one stock market, but we're playing very different games with different goals, different strategies. And it's important to realize the game that you are playing and only seek information and advice from people who are playing the same game as you are.
Very true. And we'll double click on the bubbles that you just mentioned a little later on here in the conversation. But Morgan, my investing related question for this first theme of the psychology of money is, and there's been tons of studies on this, but what do you think the one or two psychological factors that are playing a part in our investing every day that we are actually unaware of?
I think here's the thing about behavioral finance. People read about and learn about the biases of people, and almost everyone to a T. The natural reaction is to assume that those biases apply to other people, but not you. And that's the thing. Like, you read about behavioral finance and it's so fascinating because you're learning about how flawed other people can be. And if you're not looking yourself in the mirror and realize that when you are learning about all these things, you are learning about yourself. And there's almost no exceptions to these. People have different propensities, like different susceptibilities to these, but everyone is going to be impacted in some way or another by these. So I think like one of the biggest biases is like this meta bias of assuming that you're not biased, that everyone naturally has. And I think everyone naturally has it because it's hard to go about your day if you know that you are a flawed thinker. Everyone has to kind of justify their own mistakes in their head in order to go about the day in a coherent way, to have the optimism to go out in the world and make decisions about your career and your family and whatnot. You have to think that the decisions you're making are right and that your thought process in your head is clear and coherent, even if for almost none of us it perfectly is. So I think just the like underestimating your own biases is probably the largest bias.
That's fantastic, Morgan. Let's move on to the second theme of the book, which I think is kind of self-explanatory with the title here, but I'm calling it Think Longer Term. This is basically the impact of compounding on investment returns. You bring up the example of Warren Buffett starting to invest when he was 10 years old, still going strong as he's almost up to 90 now. How important is compounding for investment returns?
I mean, if you look at someone like Buffett, the point I made in the book is that 99% of his net worth came after his 50th birthday, and something like 97% came after his 65th birthday. So if you look at someone like Buffett, is he a great investor? Yes, of course. Period. End of story. He's a great investor. But his real secret, the reason that he got rich, is not because he's a great investor in the sense that he's earning high annual returns. The reason he got rich is because he's been investing consistently for 80 years. And I make this point that you can do the math in a hypothetical world where Warren Buffett started investing at age 25 rather than age 10. And he retired at age 65 like a normal person rather than investing through now he's age 90. In that hypothetical world, and let's assume that he earned the same average annual returns, but he just started investing at 25 and quit at 65. In that world, his net worth would be something like $12 million today. Not 90 billion, 12 million. So just as a simple calculation, you can tie 99.9% of his net worth just to the amount of time he has been invested for. And I think this is important because when a lot of people want to learn from Warren Buffett, emulate his success, how did he do it? They go into great deep depth and research about how he thinks about moats and business models and market cycles and management teams, which is a great thing to learn. This is not to poo-poo any of that, but it's easy to overlook that actually the reason that his net worth is what it is today is just because he has been investing for 80 years. And if he had quit at a more reasonable age, you would have never heard of him. If Warren Buffett retired at 65, you would have never heard of him. And I think this is a lot of the reason that he did not really become a household name until like his 70s. If you go back to the 1970s and the 1980s, he was famous within investing circles, but he was not kind of the household name that he is today because it took until his 80s or 90s before he became a multi-deca-billionaire, because that's just how compounding works. So I think there are a lot of things with compounding that even if you're a smart person and you understand the math, it's never intuitive. Like the power of compounding is never intuitive. You always have to take a step back and your jaw kind of hits the floor when you see the numbers. And because it's not intuitive, it's easy to overlook the actual cause of a lot of the outcomes that we aspire to. We tend to make it more complicated than it is when the answer is often right in front of us. It just has to do with the amount of time that's in front of us. And the single most important thing that any of us can do as investors to improve the odds of success in our investing endeavor is just to increase the amount of time that we are investing for.
Let me put a different spin on that too, Morgan, because Buffett has come under fire in recent years. Berkshire Hathaway has actually underperformed the S&P 500 for the last 5 and 10-year periods. And a lot of people are saying that a lot of that is because Buffett hasn't kept up with technology. Something else you brought up in your book was Daniel Kahneman, the behavioral finance professor, and you mentioned that he, in a conversation with you, had said that he really has no sunk costs. He's adaptable, he's flexible, he changes his mind when the data changes for him. And that's very different than the approach of Warren Buffett, kind of going with what he's known for 80 years in his investing style. How do you balance out kind of long-term compounding focus with the ability to be flexible and adaptable and recreate ourselves every day as an investor?
I think it's a difficult thing. I don't know if I have any good answers to that question. Like there's this quote from Munger that I love where he says, the first rule of compounding is to never interrupt it unnecessarily. So inherent in that is like, don't interrupt it. Don't change. It's kind of like some perspective. That's not his words, but I think there's some flavor to that in that advice. And it's difficult. On the other hand, there's this thing that's really interesting where Buffett has, quote unquote, like you said, not kept up with technology. True, of course. However, just because in dollar terms, not percentage terms, but in dollar terms, I think Berkshire has made more money on Apple than any other investment in the history of the investment business. He's made like $100 billion in profit on one investment. Like I honestly don't think anyone in the history of investing has made more money than Buffett has made in tech. No other, he is the most successful technology investor of all time in dollar terms. So you get these weird things with Buffett just because he's dealing with such large sums of money, but it's true. I mean, prior to his investment in Apple that's turned out so well, it is kind of jarring to think that his big bet during the era of technology of the last 15, 20 years, his big tech bet was IBM.
Right.
Like that's the one thing that he went all in on. So you do look at that and it's kind of different. It's interesting, but look, when you're worth $90 billion, you can afford to make some mistakes.
Yes, fair enough. And now my somewhat related question on this topic, Morgan, which is an interesting one, is the titles that we kind of assign to types of investors. We like to call people that they're a value investor, that they're a growth style investor. You have opinions on those titles, or are those just ridiculous?
I don't think they're ridiculous, but I think anytime that you really tie yourself to an identity, then it's very difficult to step away from that identity. If you look over historically, there are periods when value investing has done very well and then periods where growth did very well. Early in the 2000s, growth was a joke and value investing was beating the pants off of everything. You didn't want to own the tech stocks. You wanted to own ExxonMobil. That's what was doing really well. And now in the last 15 years, it's been the opposite. Like if you own value in the last 15 years, you might as well put your money in an FDIC insured bank account. Like it's been a joke, and growth has just blown everything to shreds. And like, look, that baton will pass again. I have no idea when, but that baton will pass again. It's passed all throughout history. Same with if you look at the difference between U.S. stocks and international stocks, European stocks. That too, like that baton is passed back and forth. In the early 2000s, U.S. stocks did not do very well. European stocks did phenomenal. Different, stocks from other countries around the world beat the pants off of U.S. stocks. And in the last 15 years, it's been the opposite. So I think to the extent that you pigeonhole yourself by saying, I'm a value investor, I'm an emerging markets investor, I do this, there's some benefit in there in the expertise that you might gain in that sector, but you are signing up for, and I think you have to be aware that you're signing up for periods that might last a decade or more where what you're doing is not going to be in favor. And if you can put up with that, if your investors can put up with that, then more power to you. But a lot of them can't. Look, if you are a pure value investor and you're running a value investing hedge fund, mutual fund, the last 15 years, the odds that a lot of your investors have just quit, left and redeemed their money, pretty high. The odds that you yourself might start second guessing your intelligence after you've underperformed the market for the 15th year in a row, the odds that you yourself are going to look in the mirror and say, do I really know what I'm doing? Pretty high. So as long as you know what you're signing up for, if you are pigeonholing yourself as a different flavor of investor, then it's okay. But to me, it's been a better bet, I think, to either be flexible in what you do, more of a jack of all trades, even though you don't get the benefit of specialization, or to be just more diversified in what you do. And rather than saying, I'm only doing this, I'm only doing that, you're going to have a little bit of everything, of all the different flavors mixed into it.
That makes a lot of sense. The third theme that I want to get to is called luck and risk. This was the second chapter in your book, Morgan. It's actually my favorite chapter of your entire book. And you describe this as the reality that every outcome in life is guided by forces other than individual effort. Perfectly stated. You bring up the example of Bill Gates, who is 1 in a million to actually have access to a computer so early in life. But then his partner, of course, Kent Evans, who could have been a household name for all of us in the founding of Microsoft and everything that transpired after that. It was in an accidental death in the mountains later on. What's the role of luck and then also of risk in the outcomes that we see?
Well, I think we tend to think of them as total opposites, luck and risk. Like, we don't often pair those together in the same sentence. They're completely different topics, but I actually think they're the same thing. Luck is the idea that there are things that happen in the world outside of your control that have a bigger influence on your outcomes than anything that you did. And risk is the idea that there are forces in the world that have a bigger impact on outcomes than anything that you did. They're both, I think, like as I say in the book, they're the opposite sides of the same coin, but they're really the same thing. Now, here's what's important for investors. Investors are keenly aware of risk. They talk about risk all day long. Risk-adjusted returns, hire a risk manager. Like we're managing first. Risk is like the central concept in investing, but they rarely talk about luck. Rarely, if ever, do they talk about luck, even if those two things are the same. Like you have investors who will report and adjust risk-adjusted returns. That's like a big concept in finance. Have you ever seen someone report luck-adjusted returns or hire
Never.
a luck manager? Like it never, but they're the same thing. So we know without any shadow of a doubt that luck exists in investing. It's not to say that you can't be skilled. That's not the point that I'm making. But we know that it exists in pockets. But here's the thing. If I were to say, Simon, you're just a lucky investor, I look like a jerk. And if I am to say, Morgan, I've just been a lucky investor, that's hard for me to swallow as well. It's much easier to sweep luck under the rug because if you ascribe it to someone else, you look like you're bitter or jealous. And if you ascribe it to yourself, it's a blow to your self-confidence. So we tend to ignore luck even if we know that it absolutely, of course, exists. And I think it's just important. To me, one of the big takeaways from this is that when we are looking at our investing role models, whoever they might be, it's important to realize that particularly for the extreme successes, the people who we tend to idolize, that the bigger the success, the higher the odds that there was a level of luck involved that you cannot emulate. Doesn't mean they're totally lucky. Is Bill Gates skilled and successful? Of course. Is he hardworking? Oh my gosh, probably one of the hardest working guys of our era. Is Warren Buffett skilled? Yes. Like that's not the point that I'm making, but were those guys lucky as well in a way that is going to be almost impossible for me or you to emulate? Yes. And that's an important thing to take away when we're trying to learn from the people who we are aspiring to be. The other thing is that very often the line between luck and risk, or the line between bold and reckless, is very thin. And a lot of people who we might idolize because they had an extreme success, well, the same behaviors, the same decisions that can lead to extreme success are the same behaviors and decisions that will lead to extreme failure as well. One of the examples I use in the book is of Cornelius Vanderbilt, one of the most successful tycoons of all time. His net worth adjusted for inflation was like $250 billion. And if you go back and read how he did business, how he became the most successful businessman of our time, he was breaking the law flagrantly left and right. This was his business strategy. The reason that he didn't have many competitors is because his competitors were following the law and he wasn't. This was like the key to his strategy was just giving the middle of the finger to the law. And it worked for him. He got it done. He was able to escape jail and it worked for him. It worked out. But you can so easily imagine a world where it didn't work out. And rather than becoming the richest man in the world, he ended up in jail. And the story that we think of about Cornelius Vanderbilt was not the tycoon who was so successful, but as the criminal of the 1800s. Like it's so easy to imagine that story happening. Like something else that I think is interesting is that in 2006, I think it was, maybe 2007, Yahoo offered to buy Facebook for $1 billion. And Mark Zuckerberg turned them down. He said, I'm going to keep Facebook myself. I'm not going to take it. He is praised for that decision. So insightful. He saw the future. Good job for making that great decision, for turning that down. Like a year later, Microsoft offered to buy Yahoo for $50 billion, and Yahoo turned them down. They made the same decision that Mark Zuckerberg made. And of course, it was a terrible decision. They should have taken it, gotten bought out for $50 billion. It would have been so smart for them to take that deal, because what did Yahoo become? It became next to nothing. But look, they made the same decision. But one ended up on one side, one ended up. So this is the line between bold and reckless. You usually only know it in hindsight. And what is the takeaway from that? That Mark Zuckerberg's decision ended up so well for him, and Yahoo's decision ended up so poorly for them. What are you and I supposed to learn from that? To me, I think the takeaway is just recognizing that bold and reckless live very near each other. Luck and risk live very near each other. And maybe it's just like a plea for a little bit more humility of when we are looking at trying to analyze our own successes and failures, other people's successes and failures, and what we can learn from that to try to make better decisions ourselves.
I think that's a great takeaway, especially when you're looking at the extremes, like you said in the book, that, you've got the people that are worth billions of dollars making decisions, and history writes stories about them, whether it's the Vanderbilts and the Rockefellers or the guys at Enron. Those are very different outcomes that were a similar strategy at the beginning. My investing question for you on this, Morgan, is accounting for that there is luck and that there is risk that factors into investing returns and decisions. How do you recommend incorporating a margin of safety into investing?
I think the best way for margin of safety is just this idea that you don't have a margin of safety if there's only one version of the future that works for you. If there's only one version of the future that works for you, you have no margin of safety. If you say, look, in order to do well, the economy has to grow by 4% and my portfolio has to grow by 15%. Like if that's the only situation in which you meet your goals, you're in trouble. But if you can say, look, if my portfolio returns 15% a year, great. If it only returns 4% a year, I'll do fine. I'm okay. Like I think that's when you can do okay in the widest range of outcomes, you're situating yourself, you're putting the odds of success in your favor. Versus if there's only one version of the world that works for you, the odds of success are probably not in your favor. You might do very well if that version happens to hit, but the odds of it happening are less great. Versus look, if you can do okay in most situations, you still might hit the jackpot, but you're going to do okay in the others. That I think it's easy to view that as being conservative. And I don't think that's the case. I think a lot of things that people that seem to look conservative, like you're not taking a lot of risk, actually what those people are doing is increasing the odds of success to fall in their favor. And they still might hit the jackpot, but they're going to do much better in most situations that someone who is more highly levered, taking more risk, is going to fall on their face for.
Morgan, I'm from Texas, so I'm a big Texas Hold'em fan. Do you ever play cards or Texas Hold'em?
No. Does that make me less of a, would I not be allowed in Texas because of this?
We would actually let you into the state, even though you don't play. But I'm just thinking that you would be a very good card player, knowing and explaining everything that you just did. I think that we might have to buy you in to get into the tournament.
I'll do it.
You can go kick some butt out there.
I'll do it. I like it.
Duly noted. Okay, so keep that in mind that, if we put Morgan out there on Texas Hold'em, we're going to buy him in for 7 investing so he can go out there and take some money. Fourth theme is long-term optionality. I'm sorry, long-tail optionality is what I'm calling this one, which is the idea that a very large percentage of outcomes can come from a very small number of inputs. And this is something that I really like that you dug into in the book also, Morgan. You talked about kind of how history is governed and written by long tail events. There are big events that happen in the world, like World War II, that has a huge impact on all of us. The lunar landing, the internet, all of those are long tail events that come from long tail projects also, whether that's Manhattan Project, the Apollo program, DARPANET, and the internet, or anything like that. And these are staffed by long-term thinking people who are also on those long tails as well. And so these are careers, people that really embrace that they're kind of out on the fringe and doing crazy things and extremes. And I guess I'd like you to talk a little bit about kind of how, one, this has changed over decades ago to embrace the venture capital kind of mindset. And also, technology are huge companies now. They're the largest companies in the stock market, or the Googles and the Amazons of the world. How do you think about them putting out the moonshots and the crazy ideas that they come up with every year?
I mean, here's what's really important about this. I think most people intuitively know the idea that like the majority of your gains will come from a small minority of what you do. If you invest in 30 companies, most of your gains are going to come from a few of them. If you are a business person, you come up with 10 product ideas, maybe one or two of them will work for you. I think that idea is easy to wrap your head around. What is less intuitive, even though it should be obvious when I say it, is that the counter to that, the inverse of that, if 10% of what you do accounts for the majority of your returns, the inverse of that is that 90% of what you do is not going to work. And that is very hard for people to wrap their heads around, because it is more intuitive to think that if you put your effort into something, if you do a lot of diligence on a company, if you work your butt off to create a new product for a company, start a new company, if you're a venture capitalist backing another company, if you put your effort into it, it should work. There should be a correlation between I put my effort in this, I need a return on it. So understanding that your gains will come from a few things is one thing. Understanding that 90% of what you do is going to suck, that's hard to deal with. And it can be really discouraging for people. If you are a stock investor, like even if you look at a bland index fund, I use the example in the book of the Russell 3000, just like a basic diversified index fund. If you look at it over time, 40% of the components in the Russell 3000, the individual components, lose money, the vast majority of which go to zero, go bankrupt, 40% over, I think it was a 30-year period. And virtually all of the returns from the index came from 7% of components that had huge gains. People associate that with like venture capital. Like in venture capital, you make a bunch of investments, a lot of them fail, a couple of them do well. But that's true everywhere you look. That's true in a large cap index fund. It just takes more time, but it's the same thing. And within those companies, so who are the few companies that do well? One of them is Amazon. Within Amazon has experimented with dozens of different products. But over the years, only two of them matter, Prime and AWS. They've experimented with the Fire Phone and like all kinds of stuff. Like none of that matters. All that matters is Prime and AWS. That's what moved the needle. Or something like Google. Like Google too has tried, all kinds of different things. What worked is paid search. That's what works. For Microsoft, for many years, it was Office and Windows. Like it's just a couple of things amid dozens or hundreds or thousands of attempts that work. And you can even say like, who is working at Google and Apple? It's the top 1% of Stanford Business School, Harvard Business School. Like even within the tail companies, they're driven by tail products of tail workers working on, like it's always the case that the big outcomes come from a very small minority of tries. It's just hard to wrap your head around that. And I think that the takeaway is that investors and business people and everyone, this is true for a lot of fields, need to get more comfortable with the idea of failure and learning how to fail well. And I think companies like Amazon do. Like when the Fire Phone for Amazon, when that failed, Jeff Bezos gave a press conference of sorts. And rather than saying, oh, we're so sorry, it didn't work, we'll try better, he gave a conference and he said, look, if you think this is a failure, there are a lot bigger failures to come. This was nothing. You ain't seen nothing yet. And I think that attitude is why they've been so well. Like the ability to fail well and be okay with your failures is what sets you up to enjoy and benefit from the very few things that are actually going to hit the jackpot and compound over time.
And that makes a lot of sense for somebody that's leading a large organization like a Larry Page or a Jeff Bezos, like we just described. How about for investors? And my investing question for you on this one, Morgan, is how patient should investors be with underperforming stocks? As long as we like the management team and they're in place, if it's not going anywhere, should we hold on to those or should we cut our losers and move elsewhere?
This is a really tough, if there was an easy answer to that, we'd all be a lot richer, because you have to recognize that there's a difference between patience and stubbornness. Patience is just giving your strategy the time that it needs to work and enduring with the down times that it's not going to work all the time. So you got to be patient in the times when it doesn't. Stubbornness is this idea that, look, the world does change. And there are some things where there are paradigm shifts where we're never going back to the old age. And if you stick with the old age, you're just being stubborn. You're not being patient. You're being stubborn. How do we know which is which? I mean, I think the answer is hindsight. And I don't mean that flippantly. I think for a lot of things, that is the only way that we know. If there were an easier way to know that, I mean, let me give you like the current example, which is value investing, which by and large has not worked for 15 years, let's say, 12 years, something like that. It hasn't worked. Are we in a new paradigm where value investing doesn't work anymore? Ever? It's never going to work again? Probably not. But is it the case that maybe even if the concepts of value investing are still valid, maybe some of the strategies that used to work, buying stocks at less than 2 times book value, buying stocks for less than 10 times PE ratio, making all this up, maybe those used to work and they don't anymore, and they might not ever again. That's been the case throughout history. There are strategies that used to work in the 1930s and the 1950s and 1970s that don't work anymore. And if you are just clinging to the past and assuming that everything will mean revert, then I think you're probably you're probably closer to stubborn than you are patient. So I think I wish I had a clean answer to be able to tell you which is which, but that's one of the arts of investing that I think is going to make a big difference in outcomes. And there's not a lot that we, if it were easy, then the outcomes wouldn't be as big and as prosperous potential that they do.
Yeah, absolutely. And not to mention that we have much more complete information about companies now than we did 20, 30 years ago with the internet, and giving just that to our fingertips now. Fifth topic and fifth theme for this one, Morgan, is what I'm calling necessity is the mother of invention, where technology lives to serve the needs of humankind, and people are actually in society are kind of pushing companies to do more innovative things because that's where the demand is coming from. You brought up a great point in the book about oil reserves and how America's oil reserves really got unlocked because of hydraulic fracturing to serve a higher price per barrel of oil.
Yes. I mean, if you go back to 2007, 2008, a lot of people, including myself, by the way, believed in this, commodity super cycle that oil was going to go to, it got up to $140 a barrel, but it was on its way to 250, and then it was on its way to 500. That we had run out of oil in the world, and there was nothing we can do about it. Like it was the sky was the limit for prices. Like I bought into that too, by the way. This is not a criticism of other people. And I think what I missed, that's only obvious now in hindsight, is that the cure for higher prices is higher prices. Because here's what happened. As soon as oil was $140 a barrel, and all these other complicated drilling techniques like fracturing and hydraulic drilling that were not viable at $20 a barrel, suddenly when oil is $150 a barrel, $140 a barrel, it was like, oh, now we can go spend a ton of money to drill this well and spend all this money on fracking technology and invest all this money in figuring out how to get this oil out of the ground, because prices are so high. We can make so much money if we do drill this. That began like the high prices of 2008 that scared so many of us silly, and we thought was going to be the end of civilization because we had run out of oil. Those high prices are what sparked the fracking boom, the fracking technology, what incentivized the fracking technology that eventually brought oil prices down to, earlier this year, negative $45 per barrel or whatever it was earlier this year. So the cure to higher prices being higher prices is something that's not intuitive, particularly in the moment. Like maybe it's obvious in hindsight, but in the moment, it's never that intuitive. That is what happens. And look, maybe a current example of this is that 2020 will go down in modern history as one of the worst years that we've faced. I don't think that's an exaggeration. Of what's gone on this year is just horrific. And not only have more than 1 million people died, but the economic carnage is just horrendous. If there is one silver lining to this, though, it's that the amount of scrambling innovation, panic-induced innovation that is occurring right now in laboratories and in businesses who are discovering new ways to run their business, creating new efficiencies just to survive. That if we learn anything from history, is that will pay off in a huge way. This is true during the Great Depression, where the necessity to innovate, the necessity to become more efficient, paid huge dividends over the coming decades. It's true for World War II, where the huge panicked necessity to innovate, to try to defeat the Axis powers, created a lot of new technologies that paid dividends for decades that we're still benefiting from today. Nuclear energy, rockets, jets, etc., penicillin, all these things that came out of this panic of World War II that paid benefits. I think we're probably almost certainly in something similar to that today in 2020, where, look, it's horrendous, of course, but if there's a silver lining to that, it's that people are frantically trying to figure out problems, and they will learn things from that, and there'll be discoveries that come from that will be paying off dividends for the rest of our lives.
That is my question for you, Morgan, on this one is okay, so to backtrack a bit, we've gone through kind of these super cycles of manufacturing, of energy companies, of internet companies. Where do you think that the need for innovation in the world is the greatest right now?
I think it's a good question. And it's not, sectors are not my expertise, but if I just had to think about what's going on this year, during World War II and the Cold War, the big technologies that we came through were kind of aerospace, everything from jets to rockets to GPS, that kind of stuff. Like that was because that was where the battle was. And that's where a lot of the biggest innovations took place. The battle today is with viruses. It's in medicine, it's in laboratories, it's in therapeutics, it's in vaccines. So since that's where the battle is, I suspect that's where the breakthroughs will take place. I think that seems pretty clear to me. I don't know where it's going to be. I can't give you names of pharmaceutical stocks to buy. That's not what I do. But if you just assume that where the battle is where the innovation will take place, then I would be optimistic about what's going to come out of the biotech space over the coming years. And a lot of that, by the way, we won't even recognize for another 10 or 20 years. I think there are things that are taking place right now, today, that are huge, important breakthroughs that you and I will not recognize for another 10 years. That's another common theme in history, is that it takes a long time for innovations to be recognized. Almost nothing is recognized immediately and overnight. Things take years or decades to figure out. But I have a feeling, Simon, that in 10 or 20 years, we will look back and be like, hey, this amazing thing that has made a huge difference in our lives and our kids' lives happened because of COVID-19. Like, I think the odds of that happening are very, very high.
I agree with you on that one, Morgan. I think it's the next decade is a decade of healthcare and the decade of medicine. Sixth topic that I'd like to talk about, let's call it bubbles and recessions. Again, another great chapter in your book here is kind of the idea of how does euphoric and panic conditions influence the markets in these extreme situations. We saw one earlier this year with COVID, market completely sold off in March. And just to tee you up on this topic, you actually put a quote from Napoleon at the very beginning of the book that you wrote, which says, "Genius is the man who can do the average thing when everyone around him is losing his mind." What do you think about euphoria and panic in the markets?
I think for individual investors, and not just investors, but anyone dealing with money, you need to realize the difference between getting rich and staying rich. Getting rich requires optimism. You got to swing for the fences. You got to believe that people can solve problems. You got to look ahead. You got to put yourself out there, take a risk. That's what you need to get rich. Staying rich is just as important, and it's a completely different skill set. Completely different skill set. Staying rich requires the opposite. It requires pessimism, paranoia, conservatism, not wanting to take a lot of risk, being paranoid of debt, realizing that the world is going to be a constant chain of recessions and bear markets and pandemics and breakages and things going wrong, poor political climates, etc. And realizing that even if the short run is going to be filled with problems, it does not preclude long-term growth. I think if you summarize like any period of history in any country, you can summarize it by saying the short term was a constant mess, never-ending chain of bad news. But if you zoom out, it all took place amid this backdrop of progress and growth. That's the basic story of most of civilization, is how it takes place. A lot of chaos and problems and decline and collapse amid a larger picture of growth. And I think in a shorter time frame, if you're looking at just not over hundreds of years, but during our lifetime, it will be the same. Like, I'm highly confident, highly confident by the time you and I are 80, we will look back at our lives and just see tremendous progress, huge progress that took place that made our lives better, improves the quality of our life, of our healthcare, that will, on average in society, be way richer than we were when you and I were growing up. Very confident in that. But I'm equally confident that every single year, every month, every week, for the rest of our lives, there's going to be something horrendous going on in the news. Something that is so easy to look at that will impact us personally. That's going to have an impact on our assets, our net worth. That is something we can look at and say, there's a reason to be pessimistic. That's always going to be the case, even if there's going to be a lot of progress over the long term. So I think it's hard to wrap your head around that. It's not, again, it's one of these things that's just not intuitive, to think that on your way to doing so well, you're constantly going to be falling on your face and dealing with bad news. But that's kind of the course of history that we see.
Well, and that was something else you talked about too, Morgan. It's kind of it makes it easier to sound smart when you're being pessimistic. And you say, oh, there's going to be a market sell-off. Oh, there's bad news on the horizon, versus saying, hey, long-term, there's a lot of optimism out there. I want to take this in a little bit maybe different direction and talk about volatility, because so much of that pessimism and so much of those headlines are influencing stock prices. And we see stocks go up and down. They're pretty volatile these days. We've seen a lot of days that the market as a whole is up or down 5% in a single day. And this is kind of something that you describe as the admission price of getting into the stock market. You have to pay the price of volatility, knowing that your stock prices might go up and down in the short term if you want to get the long-term gains out of the stock market. But a lot of times people are kind of averse to this, right? They don't want to pay the price. They don't want to have the pain of losing money. They only want the upside from it. How do you think about the balance between kind of we don't want to take the bad feelings that come from that admission fee, or I'm sorry, admission fine, if you will, but we also need to pay it if we want to get those long-term benefits from the stock market.
I think you just have to recognize that the stock market can provide you huge benefits and rewards. And like anything else in life, that doesn't come for free. Like no one's just giving that to you because they're nice and they want to give you, a huge reward and a huge net worth. You have to give something up for that. But the cost of admissions in investing, like the cost of a nice car is obvious. There's a price tag on it and you pay the price and you're done. It's really clear. But the price of admission, the cost of investing is not clear. There's no price tag that you pay. There's no, we're not talking about quarterly management fees. The price that you have to pay is putting up with uncertainty and volatility and putting up with decline. Now, what's important about this is that you hinted at this. A lot of people, it's more natural, it's more intuitive to view volatility as a fee. And the difference between a fee and a fine is you're not supposed to be, if you pay a fee, if you pay a fine, you did something wrong. You were speeding, you got a ticket, you're in trouble. You got to pay your fine because you did something wrong. Don't you ever do it again. That's what a fine is. A fee is like you want to go to Disneyland. It costs $80 to get in or whatever it costs. And you're fine paying that. You're fine paying $80 because you know there's something great on the other side that you are willing to pay for. I think if you just have a subtle change in your mindset as an investor, that volatility, even a lot of volatility, your portfolio goes down 30%. If you view that as not a fine, you didn't necessarily do anything wrong. Don't get mad at yourself. There's not a lot of lessons to learn here. Don't beat yourself up. That's the cost of admission that you have to be willing to pay in order to do well over time. I think if you can have that subtle shift in mindset, then dealing with volatility, and look, dealing with the volatility we had in March where my portfolio and a lot of people's fell 35%, it's not fun. It's not that I enjoy it. But I think if you can just have a shift in mindset that says, look, this isn't fun, but this is the cost of admission. The bill's coming due. I have to pay the bill. I have to pay my utility bills for my long-term returns. And I know it's going to pay off over time. I know this fee is worth it. So I'm willing to pay it to do well over the long term. I think if you can shift it just a little bit, it goes a long way to being able to endure market volatility and cycles that we're all going to have to.
Yeah, fair enough, Morgan. Now, I read a lot of headlines out there that think that fee to get into the admission of the market is getting kind of expensive right now. Everyone's calling tech stocks overvalued, the market as a whole overvalued. Do you think that there's anything behind that, or is that just a headline grabber to try to get people scared like we were talking about before?
No, I think there easily could be truth to that. But here's the thing. If you and I were talking in 2013, 2012, 2010, if you and I were talking 10 years ago, we could have said the exact same thing. 2010, we could have come on here and said, PE ratios are looking really high. If we came back 2 years later, 2012, we would have said, it's getting crazy. Things are getting really expensive. Like the difference between seeing something that looks unsustainable or identifying something that is unsustainable and knowing when it's going to turn are very different. So you can look at tech valuations today and say, look, are they expensive? Yes. Yes, they're expensive. But what do you do with that information? Does that mean you should sell? I don't think so. Does it mean you should short them? Probably not. Those are two very different things, which just gets back to being able to put up with the volatility. If you are bullish on tech stocks in terms of their business, in terms of their ability to innovate and create new products, then you should just be willing to own those companies for a long period of time and put up with the volatility. And if they are overvalued today, is there a chance that Netflix will fall more than 30% at some point in the next 10 years? I think the odds of that are close to 100%. Close to 100%. That at some point in the next 10 years, Netflix, I'm just using as an example, will fall more than 30%. If you just use that as your baseline scenario, your baseline assumption, but you're still very bullish on Netflix, the business, their ability to grow profits and whatnot, then you should just put up with that and view that as the fee that you have to pay to deal with it. So even if you have identified that stocks are expensive, it's not even clear that you should do anything about that most of the time, for most investors, I should say.
That's great, Morgan. Now, final theme I have for you. The seventh theme is what I'd call influence, which is that our decisions are shaped by the events in our life and how they impact us and how they're relevant to us, whether or not they're mathematically the greatest returns or anything else. It's more of the investing is personal story and kind of the impact of macro events that are taking place out there, whether it's 9/11, whether it's a housing boom, whether it's a housing bust, whether it's a COVID crisis, whatever it might be. It still is the influence of all of those on our personal experience that influences our investing. You brought up the stock market returns that were very different if you were born in the year 1970, much higher than if you were born in the year 1950. Or inflation, if you were born in 1960, would be 3 times higher than if you were born in 1990. How do our personal experiences have an impact on the decisions that we make as investors?
I think we all have a view of how the world works in our head. Like I have a model in my head of this is how the world works according to Morgan. You have it according to Simon. We all have this. And those models are not based off of reading about history, reading about how the world works. By and large, it's based off of just what we've happened to experience. And of course, what I've experienced is different than you've experienced, Simon. And what you and I have experienced as white males in America is very different from what the majority of the world has experienced. And therefore, we are going to see the world through a different lens, not because one of us is smarter than one another, just because we've had very different experiences. And what we've experienced firsthand is way more influential on our mind than what we can read about secondhand. Like I can try to be open-minded and read about what it's like to be a soldier on D-Day, but I don't have the emotional scar tissue of someone who actually did it. And someone like, as much as I read about it and try to be open-minded, it's not going to impact me in the slightest in terms of someone who actually did it. So we all become kind of slaves to our own past, prisoners to our own past that we have not a lot of influence over. And I think this is always going to be the case. No matter how open-minded you try to be, you're always going to anchor to your own individual, unique history that you did not have a lot of control over in terms of the generation you were born into, the values that were instilled in you by your parents, these big important things that people don't have control over those things. You don't have control when you were born, where you were born, but it has such an impact on you. So I just think it's important to realize that there's a lot that can happen in the world that will not make sense to you because it does not fit the model that you have in your head, because the model that you have in your head is based off of a tiny, tiny infinitesimal sliver of that you have seen in the world versus what's the potential to come out there. A lot of these things, the takeaway is just a greater sense of humility that your life is probably going to play out in very different ways than you think. Not because you're not smart enough to figure it out, just because the world is much bigger than the lens that you and I and all of us look through.
That's a great point. And in addition to life events influencing us, also our understanding of finance as a whole influences our investing too. Something that you brought up in the book too, Morgan, was that consumer debt, mortgages and credit cards didn't really catch on until after World War II. Index funds are less than 50 years old. Hedge funds are less than 25 years old. The 401k didn't come into play until 1978 and the Roth IRA until 1998. So if you're from a different generation, you might be thinking about investing as a whole completely differently as well.
Yeah. And there's because those things are so young, the Roth IRA is 22 years old. There has not been a generational knowledge transfer where your great-grandparents taught your grandparents, your grandparents taught your parents teach you. It just hasn't taken place because a lot of the things that we're dealing with, like saving for your own retirement, is one generation old. So we just haven't really figured it out yet. And I don't think you can blame people for not saving enough for retirement by and large, because it's such a new thing that we're dealing with. And, I would suspect that if you were to look ahead 100 years, you could see 100 years from now, people will probably be better at investing just because we'll have generational knowledge transfer that we have not over the last 100 years. So I think that's always the case. And maybe that's just a plea for having a little bit more empathy for people that do so poorly financially, just because this is all a new game for we're all trying to figure out how this works. We're all new to this.
Well, we're going to check back in when we're 80, Morgan. And so on that, my last question for you is that knowledge transfer. When we come back 40 years in the future and talk again, what would be one thing that you would say today to individual investors, just one piece of advice to help them get better returns in the stock market?
I think the holy grail of finance, 90% of finance, is live below your means and be patient. That's it. It sounds basic. It sounds trivial. But the fact that it's basic and trivial means that people discount it. They ignore it more than they should because it's not exciting to talk about. Live below your means and be patient, and the odds of success fall into your favor. If you can do those things, you'll probably be just fine.
Well, thanks very much again, Morgan Housel, one of the finest minds in finance. Here's his book, The Psychology of Money. I highly recommend it. I've read it once. I'm going to read it again. Morgan, there's just a gold mine of wealth of information in your book. Excellent job on that. Thanks for joining 7 Investing here this afternoon.
Thanks so much, Simon. This has been fun.
And thanks for tuning in to this episode of our 7 Investing podcast. We are here to empower you to invest in your future. Thanks very much, and until next time. Okay, so now we're going to move along to some questions from our audience that they asked us at 7 Investing to pass along to Morgan in a lightning round really quickly here at the end. Morgan, the first question comes from Ram. He has 2 questions for you, actually. The first question he wants to ask is, what dimensions have you improved the most in during the last decade in your research process?
I don't know about the research process, but I've probably just become more patient and more cognizant of the role of time and patience in investing success. I think that's been probably the biggest breakthrough that I've had during the last 10 years as an investor.
Okay. His second question is, what are 1 to 2 books that you would recommend to get better at writing and investing? We've already got one of them right here, but if you can give us a couple other ideas.
There's a book by Stephen Pressfield called No One Wants to Read Your Shit. It's the best book on writing I think I've ever read. And the title explains it. You want to become a better investor? No one wants to read your shit. Cut out the parts that are not very good, that people are going to tend to skip. Get to your point. Get out of people's way. I think that's the best you can do.
Short and sweet. Twitter's probably helped us a lot on that one. Third question is from Ernest Kaplan. He says, what's your favorite time management tip, Morgan?
I don't have I try to keep my day as unstructured as possible and let myself ramble and wander intellectually and physically going for walks. So I'm the last person you want to ask for time management, because I'd like to waste as much time as possible in the pursuit of creative ideas.
Fourth question for you is from Scott Bates at Scott Ontario. He says he thinks that, Morgan, you once mentioned that you had gotten a black belt in karate, he thinks, when you were younger. Yep. Do you still practice martial arts? No.
I got my second degree black belt when I was 17. That sounds right. And then quit shortly thereafter. And I'm now 36. So I'm a good 2 decades outside of this. I've never been in a fight. But maybe I could hold my own if it could happen. I don't know. With 20 years behind, a 20-year gap, maybe I could, maybe I couldn't. Who knows?
Does that have any impact on your investing?
Karate, I don't think so. I was so young. I mean, I started when I was 6 and I quit when I was 17. So I was so young. But I mean, I think a lot of the life lessons from karate are discipline, self-awareness, like physical self-awareness. I think there are a lot of like lasting life lessons that come from it.
That's fantastic. Fifth question is from Neeraj Kapoor. He's asking, why is financial literacy not taught in every school and college curriculum as mandatory teaching? Is there anything we can do about this?
Why isn't it? I think maybe one of the reasons is this. If you are looking at a classroom where there's probably a big divergence in people's financial well-being within the classroom, within a classroom, you're going to have some kids from rich parents, some kids from poor parents, even within different school districts. You're going to have a variety. It gets a little bit harder to teach good financial skills versus teaching chemistry or teaching algebra, where it's the same for everyone. I think that's, I don't know, that's not an excuse, but I think that's just something that makes teaching finance a little bit more complicated than we would assume. But should it change? Yes, it absolutely should change. I hope it changes.
Yep, good one. Sixth question is from Tin Fook. He asks, and Morgan, has anyone ever told you that you are beginning to look like High Sparrow from the Game of Thrones?
No, never. No, he was the first, but I don't know. Is that a compliment or an insult? I don't even know, which means it's probably
I think it's a compliment, right? He was a leader in the show. He was a really smart guy. I mean, I'll
take it then. If it's a compliment, I'm cool with it. Let's just run with it.
We're going to assume that was a compliment. We're going to pass that along to you, Morgan. The last question, the lightning round of questions here, is actually one coming from me. Morgan, we used to be neighbors up in Alexandria, Virginia. You would be out, I believe it was your son that was born first, if I remember. And you'd be out with your wife walking him, and I would be out with my dogs at the same time. So I would like to ask you, what is a piece of advice that you would give to your kids?
I think I brought this up earlier, that you have to realize in life where you are lucky, the parts that you are lucky in, and realize that if you are successful because of that luck, that you should be careful judging yourself and other people. Like, realize that not all success is due to hard work and not all poverty is due to laziness. And keep that in mind when you're judging yourself and other people, is I think a really important piece of advice.
That's great. Thanks very much for answering our audience's questions at 7 Investing, Morgan.
This has been fun. Thank you.